The role of mining in crypto, how coins are created. Mining Bitcoin is the process of running powerful computer servers that solve complex mathematical puzzles. These puzzles aren't random. They're what keeps the Bitcoin network secure and running smoothly. But what does that actually mean? Whenever you send Bitcoin to someone, the transaction doesn't pass through a bank or middleman. Instead, it gets bundled into a block of data. Miners compete to solve the puzzle for that block, and the first one to succeed verifies the transaction. Once confirmed, it's added to Bitcoin's public ledger, the blockchain. As a reward for this work, miners receive newly created Bitcoin. This is how fresh coins are introduced into circulation. Kind of like how a mint prints new money, but without a central authority. Now here's where it gets interesting. Bitcoin has a hard cap of 21 million coins. Nearly 20 million are already in circulation, which means the remaining supply is getting smaller and smaller. And every 4 years, the mining reward gets cut in half in an event called the halving. This slows down the rate of new coins entering the system, keeping Bitcoin scarce and driving its digital gold narrative. But mining isn't without controversy. It consumes massive amounts of energy, sparking environmental concerns. In response, some other blockchains, like Ethereum, have shifted away from mining altogether. Instead, they use a system called proof of stake, which secures the network without the need for energy-hungry machines. So mining may sound like just solving math problems, but it's actually the backbone of how Bitcoin is created, how transactions stay secure, and why Bitcoin is considered one of the scarcest digital assets in the world. If you found this information helpful, don't forget to like, share, and subscribe to the Innovative Economy.